internet is calling the stocks that we're looking at today high potential and some of the most undervalued stocks because they're selling near their 52-week lows. But let's see if the numbers behind the price agree. We're going to dive in and see if they hold up when we look at what really matters, price versus value. So real quick, let's talk about why 52-week lows are one of my favorite places to start hunting for value. Now, when most people see a stock that's way down, they panic. They say, oh no, something's wrong, I better stay away. But me, that's when I get interested because here's the truth. Not every stock that's down is broken. Sometimes great companies just fall out of favor temporarily. The stock drops, not because the business is failing, but because the market is emotional and making the fluctuations become very volatile that gives real investors an opportunity to buy in. This is where that opportunity shows up. Now listen, just because a stock looks cheap doesn't mean it's a deal. But stocks trading at or near a 52-week low, that is a great place to start looking. That's the place to begin asking, is this price drop justified? Or is it an overreaction? And if it's an overreaction, that's where smart investors can find real value. So guys, there are two camps out there. The people that look at 52-week low stocks and think, company's dead, not following it is down temporarily, or people who look at it and say, could be an opportunity. But if you see a stock at a 52-week low and automatically think it's an opportunity or automatically think it's dead, that's the wrong way to think. We still need to understand price versus value. So let's kick it off with our first stock, a stock that I personally am responsible for half its market cap, Chipotle Mexican Grill. All right, when people hear that a stock like Chipotle is down, they may get nervous. Is something wrong with the business? But here's what I always say. Price and value are two different things. Philip Fisher, he was a great investor who showed people that you need to pay more for better companies. But here's a great quote he has. The stock market is filled with individuals who know the price of everything, but the value of nothing. Good news is you're on this channel. We're here to teach that difference. Our job as investors isn't to chase hype or run from fear. It's to figure out whether the price we're paying makes sense based on the fundamentals behind it. And Chipotle, this company isn't just burritos and guacamole. It is one of the most successful fast casual restaurant brands in America. They have built an absolute machine. And now they're starting to plan on taking it global. They're expanding into new markets like South Korea, Singapore, Mexico. That's huge. Think about how many people around the world haven't even tasted Chipotle yet. If the model works overseas like it's worked here, this could be a major growth driver over the next decade. But that's not all. Chipotle is investing in automation, robots that will help peel avocados, prep bowls, speed up the line, and lower labor costs. And guys, I've always had my beef about Chipotle saying the portion sizes are inconsistent. Automation will change that. They're also doubling down on digital, mobile orders and pickup shelves. AI that learns your history and personalizes offers. Guys, remember? You used to go to Chipotle years ago and the line was going out the door for lunchtime. Now you go there and you think business is dead. No, it's just that rack of pickup orders is so much busier now. These guys are making serious moves that could drive profit margins much higher, not just revenue. So if you're a long-term investor, this should get your attention because even though the stock is near a 52-week low, the business is still good and getting better. The question is the price selling above or below the real value? Right now, some analysts believe the stock could rise 59% in the next year. But guess what? I don't care about the next year. I don't care about the next month. It is too hard to guess what will happen in the next year. What matters here is what's the value down the road, years and years down the road. This channel is built for people who want to buy stocks because they're trying to buy a piece of a business, not trying to buy something going up and down, left to right, whatever it's doing. But the key for Chipotle is one thing, execution. There are risks. Margins are getting pinched short term because Chipotle is retraining staff on portion sizes. That is not a fun headline, but they say it's temporary and the goal is to fix it with better systems. Think about it like this. Let's say you have a house, you own your home, and you have a leaky roof. And every couple of months, you got to put $500 or $1,000 into fixing that roof. But instead, you finally wake up and say, you know what? I'm just going to replace my roof. It's going to cost me $5,000, but I'm not going to be spending this 500 or 1,000. Yes, temporarily it hurts you, but in the long run, it saves you money. That's what Chipotle is doing here. So this is the kind of company that we need to dig in the numbers, ask the right questions. This is not a blind buy. And that's what I want you to learn how to do. It's the difference between guessing and investing. This is exactly what principle-driven investing is all about. We're not here to chase whatever's hot. We're not here to brag because we're up a lot in 3 or 6 months or even a year, or be upset because we're down. We're here to find great businesses and buy them when they're misunderstood and price is below value. Now, let's look at the numbers. So, first off, in our community, Chipotle has an average rating of a hold with an intrinsic value of $25. Okay, we have a $41 billion market cap. And guys, you know what I like? $46 billion enterprise value. This difference here of $5 billion is essentially their debt. But guess what? They make $1.6 billion a year in free cash flow. Last year, they did that. In the last 5 years, the average was 1.13. So you're seeing a big increase. And guys, their net income and free cash flow is essentially the same. So they're consistent. They have low levels of debt, especially for a company that has all retail and those retail leases. So far, I love this. Now, they're selling for 26 times free cash flow and earnings. Is that expensive? Well, it sounds expensive. But Philip Fisher was the one that taught us, guys, if a company is growing, if the company is a great company, you have to pay a premium. Is this an appropriate premium for Chipotle? That is a real important question we have to ask. So look at this, 12% margins, bottom line margin. That means for every $100 they bring in, at the end of the day, after paying everything, taxes, everything overhead, they're left with $12 in the last 5 years. Last year, though, 13%. That's a big jump, guys. That's nothing to be scoffed at here. Now, is it temporary? I don't know. That's what to figure out. Growth rate, 12% a year for the last 3 years, 15% a year for the last 5 years, 10% a year for the last 10 years. So in the last 3 years, they're actually growing faster than the last 10 years. Now remember, how are they going to get more growth? 2 ways. 1, opening more locations. That's what we talked about in this country as well as internationally. And 2, prices going up. That's just naturally going to drive up revenue. So these are the 2 main drivers because they're not growing from acquisitions. There's no way they're going to go find another Chipotle to go buy. It's theirs. Now, theoretically, they could go to Qdoba or one of those other places and buy them, but I don't know if that's really part of their business model, but they're just going to focus on what they're doing. Now, guys, one metric that not many people talk about, but it's very important for value investors, return on invested capital. This is important for Chipotle because as they grow, they get to put more money into the business. What this number says is that they get a good return on that money in the business. In the last 5 years, they've averaged 13.3% on the money they invest in the business. Last year, it was 20%. So it seems like it's getting better. This is a very important metric to sit there and decide, is this a premium company? So based on everything I'm seeing here, guys, this is a premium business. I've got to pay above the historical levels. Now, let's go look at their 8 pillars. So guys, we got 6 check marks and 2 X's. And the 2 X's are valuation, but we already discussed this. This company deserves a premium. The question is how much? Now, these valuation metrics here are based on their 5-year numbers, not their 1 year. So in the last 1 year, they're selling for 26 times earnings and free cash flow. But over the last 5 years, it's 36 times. Okay. As time goes on, their profit goes up. This should be higher than their 1-year number. Great returns on capital. Buying back shares, I don't know if that's good or bad. It depends on the valuation. Cash flow's up, revenue's up, net income's up, and lower debt levels. And these are all based on 5-year numbers. So the 1 years look even better. Now, guys, if you're new to the channel and you're just getting started with investing, this may feel overwhelming. Don't worry about it. It was overwhelming for me in the past. It's overwhelming for everybody who starts watching the channel. But there's a reason why we keep growing. It's because people want a way of understanding how to buy a business. So if you stick with it, I guarantee you that you'll get good information out of this and you'll become a better investor because of it. Now, I talk about these 8 pillars. This is a way of screening companies and figuring out what questions to ask. If you're new, or if you watched this before and never done it, we have an 8-pillar PDF that will explain this all to you, why they're important, why I look at them. This is why I teach on YouTube, guys. I want to make sure that people think more than just the up and down prices. I want people to ask questions. So this is a great place to start. The good news is I have made this cheat sheet for you. I made the 8 pillars absolutely free PDF. Click the link below. In a matter of minutes, they're going to send you the access to the 8-pillar PDF that'll explain all of these to you, why they're important, and what to look for in them. So make sure you do that to have a better understanding. Now, just in a couple of minutes, we're going to figure out our own price for the stock. But first, let's go see what those pesky analysts have to say about Chipotle. So guys, they have basically doubling of earnings per share from $1.23 to $2.40 over the next 4 years. Pretty solid growth rate, 9, 17, 17, 23, and 15%. And then for revenue, double digits, guys. 12.27 billion growing to 20 billion. 7.5, 12.5, 11.5, 15.5, 11.5% growth rates. Very solid growth rates. Again, premium business. So now it is time to figure out what's the right price to pay. Now, what I mean by that is, guys, I always suggest to people, run your stock analyzer very early. Look at your quick numbers, look at the analyst estimates, then run a quick stock analyzer. Because I want you to get an idea of where the company would be. Not a very tight number. But as you can see, Chipotle is selling for $30 a share. If all of a sudden you run stock analyzer and it says the value is $1, why would you waste any more time researching Chipotle? Nothing you could change here would make it a buy if the value comes up to $1. But if it's around 30 or higher than 30, then you know I need to go spend more time, go dig deeper, and then tighten up your numbers later. So I always start my research with Stock Analyzer and I end it with Stock Analyzer. So the important part is the right assumptions to make in a Stock Analyzer. This is a very common conversation in our community. And when I tell people, you got to get better about putting in good assumptions. I constantly am working at getting better at it. So for first start, I do a 10-year analysis because I like to think in terms of long outlook. As you can tell here, return on capital, like I said, is growing. Premium company. Revenue growth. I put 5, 9, and 13% over the next 10 years. Remember, the next 5 years, analysts are believing, 4 or 5 years, analysts are believing double-digit growth. So I went a little bit lower because as they get bigger, it is harder to grow. Profit margin, I put 10.5, 12, and 13.5. Same with free cash flow. This might be lower than it should be. I think I'm going to change this now because I probably haven't done this in a while. I'm going to do 11.5, 12.5, and 14 because if they can do 12.5 consistently, awesome. But they might be able to do 14 in the long run. We don't know exactly yet if they get more efficient. Next thing, what's the PE and price of free cash flow I would assign 10 years from now? Well, again, the market average is 15 to 16. You should go higher for good businesses, which Chipotle is, and go lower for bad businesses. How much higher? Well, guys, I put 18, 22, and 26. Like all these things above, this is very subjective. If somebody told me 19, 23, and 27, I'd say, okay. I'm not here to go, no, you should be 1 point higher or 1 point lower. It's about getting a general idea there. And finally, what is your desired return? Now, I always put in 9% for my intrinsic value. What's the company worth based on the market? I don't buy for a 9% return. I always want margin of safety. I want a higher return than this. So I strongly encourage you to do that. Because if you're going to get a 9% return, buy a low-cost ETF. So I hit the analyze button. The stock's at 30. Okay, I have a low price of 20, high price of 59, middle price of 34. I have my watch list at $30, which is almost there. So once it hits 30, it'll notify me. Is this enough margin of safety? That's the question. I'm actually going to change this and go a little bit lower. I want a little bit more margin of safety here. So I've changed it on my watch list so it only notifies me to hit 28. At that point, it's probably selling for 11 to 12% potential return, which makes it pretty decent for me to then start selling puts at a much lower price. Let me show you guys that real quick. Let's say I wanted to buy it, let's say at $30 a share. I could actually get paid for a month from now to buy this company. I would get paid 86 cents per share to wait for the 30 price, which is a 32% return on my cash. Now, what are the risks here? Well, the risks are it never goes below 30 and I never bought it. Okay, that's a big risk. Another risk is it goes to 22, and I just waited till then, I could have bought it for 22. Because when I sell a put, what I'm allowing somebody to do is force me to buy it at 30, no matter what the price is. So if it's at 22, I still keep my 86 cents, but now I paid 30 for it. But I'm okay with that if I'm a good investor. I sit there and say, I was fine buying it at 30. Yes, it fell to 22, fine by me. This is something that you will get better at if you're able to watch this channel. And we actually are coming up with a class very soon based on this, so make sure you watch for that. Now, guys, most investors lose money because they're trying to pick some massive growth winner. The best investors are going to do the opposite. They eliminate the losers first. That's what we're doing here when we analyze a stock. Something I learned in business very early on was the higher I made my losers, the higher I lifted my bad side, the better my top side went. Same thing in investing. If I eliminate the big losers, I am going to be able to lift my entire portfolio. So you've probably watched this and thought to yourself, oh, okay, I'm looking at this title and I'm thinking to myself, these are 3 great buys. They could be. The big thing we're trying to teach on this channel is get you to be interested and then teach you the right process. So stock number 2 is a stock I had until recently. I got very lucky, had it called away from me with a covered call. Sprouts Farmers Market, a fabulous company. But those people who just chase stock price, they see a high just 4 months ago of 182 and now sitting at $79 and think bad stock, but not you. Sprouts Farmers Market is a great grocery store, but don't let it fool you. This isn't just about selling lettuce and granola. This is a real business with real numbers behind it, and that's exactly what we care about. In fact, Sprouts is not a typical grocery store. Typical grocery stores make 1 to 2% margin. These guys are magnitudes higher than that, 6-7% margins. They've truly leaned into health and wellness. I'm talking about plant-based, keto, clean labels, private label organic snacks, the stuff more and more people are putting in their carts. And while most investors are sleeping on it, analysts are starting to take notice. It was added last year to the Russell 2000, which gave it a big boost, and the stock is sitting near a 52-week low. But many analysts have a buy rating on it, with some calling for a price target 75% higher than today. But remember what I think of analysts. Fundamentals are pointing up. That's what we care about as investors. In the third quarter, Sprouts posted 13% revenue growth, increasing profits and solid free cash flow. And this isn't just a one-off, guys. They've consistently been improving margins and increasing private label sales, which means better profits. In management, they just approved a $1 billion share repurchase. Now, if bought at the right price, that tells me something, that they believe the stock is cheap. Because when a company buys back its own stock, it's a signal that they think their shares are undervalued. Now, it doesn't always mean this. A lot of companies just buy them back because investors want that, not realizing that if the stock isn't cheap, you're wasting capital. But I think you might see what I mean as we get closer. Now, look, we are not here to say buy it because it's down on any of these companies. That isn't investing. That's speculation. That's guessing. We're here to say, let's look at the business. Let's look at the numbers. Let's ask, what am I getting for the price I'm paying? Sprouts is facing some real risks. Competition in the grocery world is fierce. And once people see these high margins, they're going to have more people going into that market. And guess what? Same-store sales came in a little weaker last quarter. And there's always supply chain stuff to think about. For those of you who don't know what same-store sales are, it's an important metric in the world of retail. It takes all the stores that have been open for 12, 15 months or longer, not the new ones, and says, okay, how are the sales in those stores? Did they go up? Because remember, you can make sales go up by adding more stores. But if those stores that existed have declining sales, you might be in a bad business. But we have to remember, that miss does not matter to us. It's short-term noise. And short-term noise does not scare a long-term investor as long as there's value there. We are buying businesses, not headlines. Sprouts might be one of those companies, but only if the fundamentals hold up. That's why we're going to keep digging into it. So, it is a $7.8 billion market cap business. Enterprise value, $10 billion. That $2 billion difference is essentially their debt. And they generated $460 million in free cash flow last year, $325 a year for the last 5 years. Guys, this is that profit margin I was talking about. 4.66% a year for the last 5 years, 5.93%. Now, here's what's interesting about Sprouts. They're increasing the number of brands in their store, items in their store that are owned private label. Now, if you see right here, their gross margin is 38% overall. But guys, their private label is 60%. That's a huge difference. So the more and more private label they put in there, the higher and higher this gross profit will go. And guess what's going to happen in bottom line? It's going to grow even faster. Is there a world in which Sprouts has 7 to 8% bottom line profit margin? Yes. Guys, Kroger is at like 1.2%. Sprouts could be 6 times better profit margin than Kroger. Think about that. Think about that. That's insane, guys. Now, that return on capital, as they invest in the business, is getting better. 11% in the last 5 years, almost 12% last year. The average rating is a buy for our community members with an intrinsic value of $105. So based on our intrinsic value of $105 by our members of our community, we've got some major upside here. Almost 30%, 35% upside here based on today's price. But guess what? When it was $182, do you see the difference here? A real investor will sit there and say, this is my value. I'm not a buyer at 182. I'm a buyer at 75. That's the key here. So let's go hit up that 8 pillar. Almost as good as Chipotle. A little bit different on the debt. 5-year debt numbers. I'm not worried about it because they're going to grow their cash flow faster. But yes, these PE ratio and price to free cash flow, it's actually lower than Chipotle. And I think this company has more growth potential than Chipotle in terms of upside from here. Analyst estimates, $5.38 per share this year, growing to $9 in the next few years. That's 15, 14.5, 14.5, and 11.5% growth rate there. And then for revenue growth, guys, look at this. A grocery store, 16, 11, 10%, 10%, 10%. Double-digit growth rates for the next 4 or 5 years. 2 ways. Opening more stores, prices going up. That's the way they do it here. Now, guys, I want to keep in mind, I started buying Sprouts at 31 to 33, got them taken away from me at 165 with covered calls. That's my point. It got way too out of hand. I was okay taking my profit at that level. Now it's getting interesting again, but I can't attach myself to my 31 to 33. If it's a great buy at 79, I should still buy it, even though I bought it at 31 or 33. It's a very hard thing to do. So now we have to sit there and figure out, is it worth it at 79? So let's pull out Sprouts. Okay, I did a 10-year analysis like before. Increasing returns on capital, that's a plus. Growth rate, 6, 8, and 10% a year for the next 10 years. Profit margin, I did 5.5, 6.5, 7.5. Guys, I put my lowest level basically at today's 1-year mark because I think their profit margin is going to keep going higher. PE, 16, 19, and 22, and again, my 9% return. Guys, I have felt that panic in my gut as well. When stocks fall, fear takes over. You start thinking, do I sell before it gets worse? I've been there. I've made those emotional decisions and I paid heavily for them. But patience and planning are what separates principle-driven investors from degenerate gamblers. Once you understand value and how to determine it, your perspective completely transforms. Price drops become golden opportunities, not disasters. That's what we teach at Everything Money. How to think long-term and stay calm when other investors start losing their minds and they dig holes that kneecap their financial future. Get access to the tools and the knowledge that protect your portfolio and your future from those emotional decisions that will destroy wealth. Start your 7-day trial right now. Now, guys, I hit the analyze button. Boom. 96 on the low side, 220 on the high side, 150 in the middle. Keep in mind, if the stock was at 180 right now, you'd only have this in green. You wouldn't have this kind of potential return at 180. That's the key. I want you to beat this into your brains that at the wrong price, all of this would have been the same, but at a different price, at double the price, it would not have been all green. That's what you have to remember here. This company is very interesting for this exact reason. And guys, I have puts on it at about $80 a share, so I'm likely going to get them. But let's say I want to add to that. If I go to the options chain and let's say I want to buy it for $75 here in the next month, I'm going to get $2.65 per share. That's a 33% cash return on my money. I'm being paid to wait for the stock to fall to the price I want it to fall to. That's what's incredible here. So again, I can't attach myself to what I paid for it in the past. I have to look at it as new money going to a new business where the numbers are a little bit different than before. That is what's key here. That's what I want you to learn on this channel. Stock number 3, a company that I currently own, but remember, don't ever buy a company because somebody on the internet says it's a great buy or owns it themselves. Target. This is our third and final stock near a 52-week low. Target is one of the biggest retailers in the entire country with a name that everyone recognizes, especially your wives and girlfriends. And for any women watching, you know you love going to Target. And yet the stock has been beaten down hard. So the obvious question is, why? And more importantly, is it permanently broken? Is it a permanently broken business, or is it a temporary break? So let's start with what's going wrong. Target has been hit from all sides. Inflation, tariffs, these have both squeezed their profits. Consumers are spending less, especially on non-essential stuff. Their recent earnings were rough, big drop in profits and soft sales. They've also had some controversies that have hurt the public perception and led to some boycotts. And on top of all of that, they're facing fierce competition from Amazon and Walmart. Now, that sounds like a lot, and it is. But for us value investors, this is what matters. Is there opportunity here? That's the question we have to ask. Some analysts still see value in Target's brand strength, their massive loyalty program, and their ability to bounce back over the next few years as they get leaner and more efficient. There's also a potential boost from future earnings growth, especially when consumer confidence rebounds. Remember, consumer confidence and people's lack of spending is not a permanent thing. It is temporary. So here's how we think about it from a principle-driven lens. Is the current price reflecting fear or fair value? Do the fundamentals show signs of recovery? And if Target's future looks brighter than today's stock price suggests, is there enough margin of safety to buy? Because we're not just here to buy when it's down. We're here to buy great businesses at great prices. Target is clearly facing some real challenges, but we don't invest on headlines. We invest based on cash flow, valuation, balance sheet, and execution. So, if the numbers line up, and if you believe Target can steady the ship, it might be worth a deeper look. And that's the skill we're teaching here, how to separate the panic from the potential. So let's take a look at this. It is a $41 billion company with a lot of debt. What's that debt? Retail leases. Now, guys, their 5-year average free cash flow, $3.3 billion. Last year, $2.95. So it's declined. You see that right here in profit margin as well. 4.22% over the last 5-year average, 3.7 last year. But here's what's interesting, guys. It's selling for 10 times earnings, 12.5 times free cash flow. What world do we live in 20, 30 years from now, Target's gone? Could it happen? Absolutely. Amazon's making major strides. But guys, I'm going to let you know, I love buying from Amazon. But if I know I'm out and about, why would I go to Amazon? Sometimes I even look at Amazon going, oh, I don't want to wait 2 days. Now, is Amazon going to get better at that? Absolutely. But my sister-in-law put it great several years ago about Target, not just now. She said Target makes it super easy for her to buy stuff online. They come, they drop it off, or she's out and about, she picks it up. Very easy. That's the name of the game there. And guess what? Returns are probably easier at Target in terms of talking to somebody. Yes, for Amazon, it's great. But if you buy something at Target and it's damaged, you're going into the store to say, hey, this thing is damaged. At Amazon, you got to worry, are they going to validate this? What's going to happen there? And guess what? Amazon will get better at that. But it's still important to understand this. Okay. Other thing, 5-year returns on capital, 14.25%. Return on invested capital, 11.2. Now, our community members have this as a buy with an intrinsic value of 96. And also, look at the growth rate, revenue, 3.7% a year for the last 10 years, 4.5 for the last 5 years, negative for the last 3 years. Yeah, they're struggling right now. Hopefully that will get better. So let's look at the 8 pillars. All right, debt's high, not worried about it because it's the retail, and free cash flow is definitely down significantly over the last 5 years. That matters. That really does matter. The question is it temporary or is it permanent? That's what we have to ask ourselves. All right, so analyst estimates. Well, analysts see a dip of 15% in earnings per share, then back to growth. 8.5, 7, 12%, growing to $10.40 over the next 5 years. And revenue, again, a little bit of a dip and then back to growth, but not a lot of growth. They have them growing 2%, 2.5%, 2%, and 3%. Guys, that's not a lot of growth. Just based on inflation, they should do that. And if they're opening more locations, it seems a little low, but maybe they're right. I don't know. So guys, let's go pull up Target the last time I did it for 10 years. Here are my assumptions. 2, 3.5, and 5%. Oh, by the way, guys, for you people who love dividends, it's really important here. They are paying a dividend of almost 5%. Don't fall in love with it yet. It eats up $2 billion of their $3 billion in free cash flow. If the business gets worse, that will be first to go. And when we run our stock analyzer numbers, our returns at the bottom include that dividend. So don't add it on top. So back to it. Profit margin, I did 3, 4, and 5%. So I think I'm still pretty conservative here. PE, 14, 17, and 20. So I beat it down a little bit because it's retail, still has big competition. I probably should have put that in my margin of safety, but that's okay. And again, my 9% return. So remember, before I hit the analyze button, if that what I said earlier about selling cash secured puts to buy a stock, be paid to buy a stock at a lower price, pay attention. It's going to start at the beginning of next year. So if you ever want to learn how to generate a return above 4 or 5% on the cash in your business and buying great companies at better prices, that's the way you do it. So if you want access to this class, we're going to give it to everybody on the email list first. Click the link in the description below. Make sure you're signed up to get updates in the future. Get first dibs because this option class could be a game changer for your investing. It's something I wish I learned 25 years ago. So I hit the analyze button. Boom. Low price of 95, high price of 246, middle price of 160. Guys, I didn't make absurd assumptions here, and I still have a middle return of 17.5% based on a discounted cash flow model. Now, guys, earlier this year, I picked 7 stocks to go head-to-head with the market's Magnificent 7, my own personal Magnificent 7. Click the video on your screen to see which 7 stocks I picked and how they're stacking up. The results may surprise you. Thank you for your time.